Hi everyone, and welcome to the APAC LNG Day. We are very happy to have you with us today. We have a very dense program today, very interesting topics to deal with. This is the agenda. You probably already saw it. We will start with the LNG supply and demand updates, and then go to some to see some market dynamics around LNG, global natural gas market status and outlook. Then we will go to the next topic: the leverage and manage the increasing volatility in LNG freight market. And the last presentation of this LNG seminar will be from Spark Commodities, which is a toolkit, interesting toolkits for understanding LNG freight prices. I would like to thank Dr. Behua for being with us today, Dr. Behua from CNPC. But I will let Karen, our head of sales for the APAC region, to introduce the various speakers today. We have a lot of speakers, mostly from Kpler, not only. Karen, can you introduce the speakers?
Yes, thank you, Arthur. Welcome everybody. Good afternoon and good morning if you're in different regions. I'm very excited. My name is Karen Chan. I'm the head of commercial sales for Asia Pacific, based in Singapore, and I warmly welcome all of you to our very first APAC LNG Day. So as all of you know that Kpler does have a lot of coverage around different aspects of LNG. So we believe that today's program is going to be very beneficial for most of you. So I'm going to quickly introduce to you all our presenters today. Coming in first would be from our research team, Ms. Laura Page, who is our senior LNG analyst, followed by senior editorial manager, Camille Klaas. And following the research team, we also have our data team, our gas data team, with Charles Costerus, LNG and LPG analyst, with our Asian LNG analyst, Matthew Ang. Talking a bit more on the LNG market dynamics. And as Arthur has mentioned to all of you, we have very privileged to have Dr. Bai Hua, who is the senior economist from the CNPC Economics and Research Institute, to be with us, covering some of the Chinese trends. Dr. Bai will be presenting in Chinese, but the slides will be in English, so everybody can benefit from this presentation. And not to forget, most of us are also very interested in the freight markets. You know, it's playing a big key role in our trading and seaborne markets. So we have the Kpler's freight team, Matt Wright, our senior freight analyst, as well as Mr. Wang Dingwen, our product analyst, who is based in Singapore, to present the leverage and managing of the increasing volatility in the LNG freight markets. And last but not least, we have our sister company, Mr. Henry Bennett from Spark, to come and share with us what Spark has in store for us for the LNG pricing. So without taking much time, I'm going to quickly pass to my colleague, Kenny Gong, who is based in Shanghai. He's our senior account manager. So he's going to quickly run through a couple of slides just to tell some of you who are not familiar with Kpler, who Kpler is, before we start the program. Kenny?
Hi, everyone. Good morning and good afternoon. I'm Kenny Gong, Senior Account Manager of China Market. Kpler is an international data intelligence company providing real-time transparency solutions in commodity markets. Kpler's leading edge includes proven worldwide track record, innovative technology, robust methodology, seasoned market analysis, 24/7 support, worldwide customer success to satisfy the customers. Next slide. Started in Paris, we quickly opened new offices in major commodity trading hubs. And within some years, Kpler has offices in Singapore, Houston, New York, London, Dubai, Tokyo, and Shanghai. As of today, there are over 160 employees working in those different offices. Next slide. We started to track global LNG flows in 2014. Since then, Kpler has focused on including new types of commodities into our scope. We now cover all commodities, LNG, LPG, crude oil, oil refined products, petrochemical, biofuel, and dry bulk, and more. We have also expanded to new segments of the value chain with added transparency on oil storage facilities and the freight to our scope. With this, thank you again for everyone attending our APAC LNG Day seminar. Now I will hand over to Arthur.
Yeah, thank you for this introduction, Kenny. Thank you, Karen. Let's jump in the very first sub-part of this seminar with Camille Klaas, based in Singapore, who is our Senior Editorial Manager, and Laura Page, based in London, who is Senior Research Analyst. They will speak about the LNG demand and supply. The mic, I'm passing the mic to them. You can start, Laura and Camille.
Okay, thanks very much, Arthur. Hi, everyone, and thank you for joining us. So in the slides I'm going to cover, we look at how LNG prices have performed, as well as some of the drivers on the demand side that have contributed to the staggering price increase this year, and what the potential is for further upside. Next slide. I think it's safe to say that the price developments this year have taken most people by surprise. Prices went from all-time lows below $2 at the end of last April to an unprecedented high in January, 9 months later. And another 9 months later, here we are again, having hit all-time highs again, and the winter has yet to begin. So the question on everyone's minds, of course, is just how much higher can prices go? A lot will depend on the weather and how this affects demand in Asia, Europe, and South America, as we've seen robust demand from all three regions this year. Demand from Asia, primarily Northeast Asia, has fueled the gains in Asian LNG prices, which have risen by almost six-fold from their low in March until now. Unlike last year, when supply-side issues were key in helping the market to rebalance, much of this year's gains have been driven by the demand side, although we have had production disruptions and unplanned maintenance at various projects. In addition to Northeast Asia, Argentina, Brazil, and Pakistan emerged with strong demand this year as well, which has pulled cargoes away from Europe and tightened overall supply availability. This has meant that Europe has not been able to replenish stocks adequately following an extremely cold winter earlier this year, which depleted its gas stocks. And aggressive buying by Northeast Asia in the first half of this year has meant that Northeast Asian buyers were paying more to ensure cargoes came to Northeast Asia instead of going to Europe. And that explains the widening differential between the JKM and TTF price. But in the run-up to winter, competition between Asia and Europe has been heating up, which has resulted in greater fluctuations in the spread between TTF and JKM prices. And given the dynamic situation, suppliers with flexible US cargoes are constantly monitoring the spread to assess where they should ship their cargoes to in order to determine the best netback value. Next slide. So because of Europe's inability to replenish stocks quickly enough through pipeline and LNG imports, the region has gone from being a balancing market to a market that's actually drawing substantial supply. And what's underpinning the benchmark TTF price is concern over how Europe will meet demand this winter. The chart on the right-hand side of the screen shows a change in European underground storage levels versus a 5-year average. And you'll see that while the percentage change has lessened in recent months from around 30 percentage points in March, it's still substantial at around 20 percentage points. So storage levels were around 77% full on October 20th, compared to 94.6% full on the same time last year. This is the lowest level that stocks have fallen to in the last 5 years. Now, Europe's LNG imports are also weaker against last year. While they were up against month earlier levels in March and May, January to September receipts this year are down by around 20% against the same period last year. Asia's thirst for LNG has left Europe hungry, but Europe has also had to contend with Norwegian gas field maintenance during the second quarter, reduced Russian flows, lower wind output, and high carbon prices, which prevented it from building up ample inventories. This week, Turkey's BOTAS closed a tender for 19 cargoes for delivery across November to March, and they may not have awarded any cargoes. Some people are suggesting perhaps 2 to 4 cargoes may have been awarded, with the rest under negotiation. The results are still unclear, but whatever it is, it would be on top of around 15 cargoes for October to February that they bought at the end of September through a tender for 20 cargoes. So all eyes on Russia now to see if it will step up flows to Europe, given that Russian President Putin has pledged to stabilize the market. There are still some hopes that gas from Russia's Nord Stream 2 pipeline will flow this winter, but a draft decision on certifying the Nord Stream 2 operator will only be produced in early January. In the meantime, Europe is trying to manage with gas shortages amid escalating power prices by freezing gas prices in France, cutting value-added taxes on power bills in Spain, and allocating funds to offset fuel price increases in the Netherlands. Next slide. So as you can see from the chart, China's demand has been far and away the strongest this year, thanks to a rebound in the economy early this year because of strong recovery from the COVID pandemic. China imported 59.5 million tons between January and September this year, which is around 22% more than it did over the same period last year. It's overtaken Japan as the largest LNG importer, with Japan's imports for the period standing slightly lower at 57.7 million tons. Now, the memory of a very cold winter early this year is probably very fresh in the minds of buyers in China and the rest of Northeast Asia when they were pushed to begin restocking. We saw CNOOC emerge with a tender in February for 10 cargoes to be delivered between May this year and March next year. Sinopec also had a tender for second half 2021 and February 2022 cargoes in April, and probably bought at least 35 cargoes through that tender, which is a little over 2 million tons of LNG, we understand. Other Chinese buyers such as ENN, Beijing Gas, Guangdong Energy, and Guangzhou Gas were also seeking cargoes this year. And some of this demand was driven by them having secured import slots at PipeChina's terminals. Now, Japanese and Korean buyers and Taiwan CPT have also stocked up earlier this year, and most market participants expected that Northeast Asian buyers had at least covered their base requirements for winter by July. And in hindsight, the early restocking probably made sense because LNG prices were still in the single digits before June. But even amid the current elevated price levels, we have seen demand emerge recently from Taiwan, Japan, and China's Unipec. Unipec surprised the market with its tender for November to March cargoes at the end of last month, buying around 13 or 15 cargoes. We understand Taiwan CPC bought around 12 November to February cargoes through 2 tenders from early September. And Japan's Tohoku Electric also bought around 12 cargoes through 2 tenders, one that closed last week and another which closed in early October. Tohoku's cargoes are for delivery across 2022 to 2023, but do include winter volumes from what we understand. They bought lots of cargoes on a Brent-linked basis in order to avoid paying prices that are linked to spot LNG prices. Now, as far as South America goes, a severe drought in Brazil and Argentina increased their call on LNG, and Brazil's imports are set to hit an all-time high this month. Argentina has issued tenders regularly this month. It's seeking 1 cargo in November and 1 cargo in December through a tender that's still open after not awarding 4 October to December cargoes because offers were too high. Pakistan has also helped to mop up supplies, with both Pakistan State Oil and Pakistan LNG issuing numerous tenders to buy across this year. But higher prices have prevented the firms from fully awarding their requirements. Spot market volatility hasn't helped either, as Pakistan LNG received no offers for a tender closed on October 11th for 8 December to January cargoes. It isn't clear if it will retender at these very high prices, but the lack of LNG cargoes raises concerns about power shortages in the country. Next slide. So while China has been the driver of LNG demand this year, economic indicators are showing signs of weakness because of a power supply crunch and very high fuel prices. Coal shortages and extensive power supply cuts have forced some factories to shut. And the expectation is that this may reduce demand for LNG instead of boosting demand for gas-fired power generation, because spot LNG prices are just too high. We do hear, however, that a few firms may still be looking for December and January cargoes, but there is a lot of wait and see, as buyers are nervous about committing to more cargoes with prices at all-time highs, just in case the weather does not turn out to be a severely just in case the winter does not turn out to be a severely cold one. Unipex's tender to buy November to January cargoes was the last tender from China to be awarded, and a subsequent tender by Shenzhen Energy for 1 November and 1 December cargo was not awarded because offers were too high. We understand that Shenzhen Energy had import slots to fill at PipeChina's Guidong and Tiefu terminals. And we also are aware that a number of second-tier buyers holding spot import slots in the fourth quarter will likely give up these slots because LNG prices are not affordable for them to bring cargoes into China without making a loss. Domestic LNG prices are around $19.50 per MMBTU, whereas prices for November and December are in the 30s. But China seems to have made arrangements to secure adequate gas supplies to tide through a normal winter through spot LNG purchases, pipeline supplies, and increased domestic output, which have gone towards filling underground gas storage sites. And several long-term deals, including one Sinopec and Shell signed with Kpler for a total of 6.5 MTPA starting in January, will pair spot LNG demand this winter. Some of these deals were signed at slopes of around low 10% of Brent, making them very competitive against current spot prices. China will also receive double the volume it did last year from the Power of Siberia 1 pipeline from Russia. So that would be 10 BCM instead of 5 BCM. And we understand that CNPC may have recently signed a contract with a Central Asian supplier for more pipeline gas volumes this winter. Temperatures in China dropped to low single digits this week, while Korea experienced its first snowfall over the weekend. And Japan's National Weather Agency changed its forecast 10 days ago to a 60% likelihood of a La Nina impact this winter from a 70% probability of no La Nina. So La Nina's impact on demand in Europe, Asia, and Latin America remain a key uncertainty this winter. It brought frigid temperatures early this year to Europe and Asia, and drier weather to South America, worsening drought conditions there. We know what happened earlier this year, and the concern now is whether there will be enough supply to meet emerging demand if the weather does turn out to be sharply below average levels. And I'll hand over now to Laura, who'll delve into the supply side of things. Over to you, Laura.
Thank you very much, Camille, for covering the demand side. Very interesting there. So as Camille mentioned, I'm going to be covering the supply side today. And you can see from the charts that over the first 9 months of this year, global LNG supply is around 286 million tonnes. And that's up 5% compared to the same time last year. Now, this waterfall chart portrays quite nicely the growth that we're seeing from the United States. So you can see around 21 million tons of growth has come from that region in the first 9 months of this year. And that's really mainly due to the fact that we haven't seen US cargo cancellations this summer like we did last summer. And that's no surprise given the record high prices that we're seeing in the market at the moment. Also in the United States, we've had a little bit of additional capacity coming online over the last year or so, which has ramped up to full production now, which is adding a little bit of supply growth as well. We've also had strong supply from Egypt, so around 4 million tons of extra production there. So in February, we had the restart of the Damietta terminal, which has come online and added to capacity alongside the Idku terminal as well. And what we're seeing in Egypt is higher gas production, and also they're importing pipeline gas from Israel. And that's enabling the country to meet their domestic demand, but also to allocate any surplus gas to the export market. So this is a growing trend that we're seeing in Egypt. Also additional supply from the United States over the first 9 months. Lots of issues at plants last year in Australia. Prelude was offline for a lot of the year. We had all those issues at Gorgon as well, which have now been resolved in the last couple of months. So we're seeing additional supply there. But what you can see from the red bars here is really dwindling supply from the rest of the Atlantic basin. So we've had a number of issues at plants, which has really paired that supply growth that we're seeing in the market. So Trinidad and Tobago, for example, we're seeing lower domestic gas production there, and they've idled one of the trains at the Point Fortin plant as well. Nigeria, we're seeing maturing gas fields there, which is weighing on the supply side as well. Norway, the Hammerfest plant had a fire in 2020, September 2020. That's been offline ever since for repairs and is due to come back online in March. So we'll miss out on the winter period unless it restarts early. And a number of production issues in Peru this summer as well. So that's really paring down the supply side and tightening the market balance alongside the strong demand that we've been seeing from Asia and South America that Camille was mentioning earlier. Next slide. So we spoke just then about supply losses, and here I'm looking at supply losses, but more on a global basis. So I've been looking at production at every plant in the world and comparing that to the typical production levels that we'd see at those plants, so not against nameplate capacity here. What this chart essentially does is aggregates all of the areas where we've seen production losses, whether it's planned maintenance or unplanned supply disruptions as well, and compares those figures for 2021 versus 2020 and 2019 as well. What I've excluded from this chart is any losses due to market weakness that we've been seeing. So like I mentioned, those US cargo cancellations and those, in Egypt last year, we had hardly any cargoes being exported due to the low spot prices. So that's excluded from that chart. But what you can see quite nicely is a build up in supply losses through 2021 versus the last 2 years. So, Atlantic Basin has seen a lot of supply losses, like I mentioned, but we've also seen, planned maintenance taking place in places like Australia, Russia as well, that got delayed from last year as well. So bear that in mind. As we're going through October, production is starting to increase now. We're coming out of maintenance season, so we're seeing that typical seasonal uptick in supply. However, we do expect to see some supply disruptions still ongoing in the Atlantic Basin. We don't expect the Trinidad plant, for example, to come back to full production. Norway is still expected to be offline until March of next year. We're also seeing some issues in Malaysia as well at the Bintulu plant. So definitely bear that in mind, that we will continue to see supply disruptions through the winter. And there's, of course, always those unplanned issues that we can't forecast for either. So over to the next slide, please. So looking ahead to the winter season and where we could see additional supply coming from, this is really going to be only from the United States. So there will be 2 plants coming online this winter. The first of which is a 5 MTPA train 6 at Sabine Pass. That train has received approval to start feed gas flows last month, and we'd expect to see a first cargo potentially next month. So we think that Cheniere will want to try and get output going at that plant as soon as possible, given the high spot prices that we're seeing and really capturing that winter market. The second place where we see extra capacity this winter will be the 10 MTPA Calcasieu Pass plant. This is a greenfield plant, but it's formed of 18 mini trains. So very different to the previous plants that we've seen in the United States, but quite similar to that of Elba Island. So the 18 trains will have 0.6 MTPA capacity, and they'll come online between any time now and the middle of 2022 as well. So feed gas flows into that plant have not yet started yet, but we'd expect them to start in the next couple of months and cargo exports to follow quite quickly after that. So when we look at supply from the United States, we had about 33 million tons of supply last winter. With the additional capacity coming online and potentially some higher utilization rates at some plants, we expect to see just over 38 million tons of supply for this winter. So be aware that we will see extra capacity and extra supply from the United States. So thank you very much for listening, and I'll pass back over to you, Arthur.
Thank you very much, Laura and Camille, for those very interesting insights. We'll now move on to the next section, but before this, I forgot to mention at the beginning of this seminar that given that we have a lot to cover today, we will not be able to take live questions. However, you are free to post your questions in the Q&A box of your Zoom window. We will gather the questions and we will come back to you individually. So do not hesitate to ask questions, to drop your questions in the Q&A box. We're going to take good note of those questions. Now, we are moving to the global LNG market dynamics. And I guess Matthew is the first speaker.
Thank you, Arthur. Good afternoon, everyone. My name is Matthew, and I'm an LNG analyst based in Singapore. So together with my colleague, Charles, an LNG and LPG analyst based in London, we'll be presenting on the topics of global LNG market dynamics through our slides. So I'll be going through the LNG imports into the Far East market, and as well as the utilization percentage of the LNG export terminals. And Charles will be going through the European re-exports, Northern Sea routes, Qatar gas trading strategy, and lastly, the European natural gas inventory. So on this slide, to kickstart the presentation from my end, I will be going through the progression of the LNG imports into Far East by its origin country. So the main places that are considered to be located in the Far East are China, Japan, Korea, Taiwan, Thailand, Singapore, Indonesia, and Malaysia. Right, so from the chart on the left, we can see that the LNG imports into Far East in general has gradually increased throughout the years from around 170 million tons in 2014 to 221 million tons in 2020. Looking at the imports by the origin countries, we can see that the LNG imports into Far East by Qatar was the highest compared to other countries in 2014 at 44 million tons. It has since declined to 24 million tons in 2020. And by the end of this year, quite a number of LNG SPAs that Qatar had signed with Japanese companies like Tokyo Gas, Osaka Gas, JERA, etc., are set to expire. So these are mainly the Qatar Gas 1 SPAs. So these contract volumes alone account for nearly 10% of the Japan's annual 2020 LNG import. Australia, on the other hand, overtook Qatar in 2016 at 42 million tonnes and is currently leading with LNG imports into Far East this year. So there were a number of commissioning of LNG trains since 2015 to 2019, which led to the sharp increase of LNG imports into Far East. And as for the United States, the LNG imports into Far East from US has steadily increased since 2016 due to the commissioning of LNG trains since 2016 as well. Yeah, so we also do take note that there has been stagnant LNG imports into Far East from Malaysia, Indonesia, Oman, and UAE over the years. Next slide. So in this slide, we'll be looking at the year-to-date utilization percentage of the LNG export terminals globally. So in the scatter plot on the left, the LNG export terminals are represented by dots, plotted by its utilization percentage against its nameplate capacity, and they are sized according to their LNG export volume. We have split the LNG terminals by continents, mainly Africa in blue, Americas in orange, Asia in green, Europe in brown, and Oceania in yellow. For example, we have Sabine Pass classified under Americas, which is marked by orange color. So the utilization percentage is defined as the LNG export volume prorated against its nameplate capacity. For LNG export terminals that has utilization percentage near 100% would mean that the LNG export terminal is exporting according to its nameplate capacity. So typically, the utilization percentage of LNG terminals will tend to hover near 90 to 100% as the nameplate capacity will typically match 50 SPA's volume for that installation. So in this scatter chart, it can be observed that the LNG export out of the largest LNG terminal, Ras Laffan, is near 100% this year. So we will narrow this chart down by excluding Ras Laffan, this scatter plot, to have a clearer picture of the rest of the LNG terminals. Next slide. So in this narrow scatter chart, we have LNG export terminals with nameplate capacity ranging from 1.5 million tonne per annum to 30 MTPA. So at a quick glance, it can be observed that around 45% of the LNG export terminals attain 80% rate, 80% utilization rate or less due to several cases of extended planned maintenance or even outages of LNG terminals this year. So for example, Sakhalin 2 experienced extended planned maintenance in August, and Skidar was out temporarily from June to August due to technical issue. Right, so this is actually quite significant in a way where if for the larger LNG export terminals, like the 29.3 MTPA Bintulu and 22.2 MTPA Bonny LNG, both currently attaining 80% utilization rate year to date. So in other words, that means they could have been producing at least a total of 10% more if they were to hit the max utilization rate. So in comparison for Bonny LNG last year, Bonny LNG achieved 96% utilization rate last year as compared to just 80% utilization rate year to date. So if we break it down to the continent level, most of Africa's LNG export terminal in blue have attained 80% or less, right? Whereas for the America's LNG export terminals in orange, they have achieved more than 85% utilization rate, especially for the US export terminals. With the exception of Peru LNG and Atlantic LNG, they have both attained less than 50% utilization rate, far below last year level. For both the Asia LNG export terminals in green and Oceania in yellow, respectively, they are pretty much scattered across the board, ranging from 40% utilization rate at Bontang LNG terminal to 106% utilization rate at Wheatstone LNG. And lastly, for Yamal, it has the highest utilization rate this year at 119%. So apart from just looking at the utilization rate and the LNG export from each individual terminal from this scatter plot. There are also a few ways to look at this scatter plot based on other metrics and variables. So next slide. So in this scatter chart, we can also examine the LNG export terminals based on how much their exports are heading towards the Far East. So we can distinguish which LNG terminals are crucial in terms of supplying LNG to the Far East market, and roughly gauge the impact if any of these LNG terminals is experiencing an outage of unplanned maintenance heading towards the winter. So in this scatter chart on the left, can be observed that LNG export from Asia and Oceania are currently contributing the most to LNG imports into Far East. So for example, Lamad LNG is exporting 100% of its export to the Far East market. So hence we can see that the size of the dot is relatively large. Right, so some of these LNG terminals have been underutilized this year, such as Ichthys, Gladstone LNG, and as well as Prelude. Right, so whereas if you look at the LNG terminals in the Americas and Africa continent, some of the LNG terminals are not significant in terms of supplying LNG to the Far East market. So some of these LNG terminals are the Atlantic LNG, 15.3 MTPA. So 8% of its total LNG export is here into Far East. And then you have 2.5 MTPA Elba Island, where 70% of its total LNG export are headed into Far East, and 4.5 MTPA of Skidda, which none of its LNG export is currently headed to Far East this year. So any outage or any unplanned maintenance of these LNG terminals might perhaps weigh a relatively lesser impact to the supply into the Far East region as compared to the rest of the LNG terminal in Asia. There are other ways where this scatter chart could be sized towards, perhaps to individual destination countries such as China, Japan, or even South Korea, or perhaps even on a different zone level, for example, Europe, which might show even a more detailed and targeted trends. Right, so the utilization percentage of these LNG export terminals can vary depending on the time frame as well. Right, so for example, there is 60, 90 days utilization rate. So such metrics are derived from Kpler's data, which can be accessible through our platform. So yeah, to conclude, as observed from the relatively low year-to-date utilization rate for some of the LNG export terminals, it is evident that the LNG market is facing a supply crunch this year. So now I will pass on to my colleague Charles to go through on his slides on the other parts of the global LNG market dynamics. Charles, please.
Thanks, Matthew. That was some very insightful topics. So as Matthew just mentioned, I'll be discussing some various topics that are currently relevant in the LNG market at the moment and that are linked to the Far East. So on this first slide, we'll be looking at the Northern Sea Route, or the NSR, which is a popular route for ex-Yamal cargoes going eastwards to Asia. It's typically used in the warmer months where there is less ice and the seasonality is quite visible. So when this route is used, it will typically represent 5 to 40% of all Russian exports going to Asia. And this will be at the detriment of the Suez Canal. The rationale behind using it is that it can save considerable amounts of time and distance for Russian cargoes discharging into Asian markets, and this even as far as East Coast India. So if we imagine a voyage from Yamal to Tianjin, using the NSR will only take 15 days versus the traditional route via the Suez Canal, which will take 36 days in total. So effectively, the NSR is twice as quick in terms of time, distance, and there are also no canal fees to pay. If we look at the graph on the slide, especially in Q3 this year, with the rise in LNG prices that we've seen, there has been an increase of Russian cargoes to Asia via the NSR, especially in September, where we've seen a record 12 cargoes out of Yamal going via this route. Looking at the period for January-September this year, 60% of all of these volumes on the graph were sent to China, with Kaofeidian and Rudong terminals receiving the largest volumes. 25% of those volumes went to Japan, and the remainder went to South Korea, Taiwan, and India. So while Asia is a preferred destination for Russian cargoes, like it has been recently, that translates to more vessels using the NSR route, and therefore Europe loses out on much needed Russian supply. Indeed, in September this year, only 34% of volumes out of Yamal were delivered to Europe, and this was the lowest level that we've seen since August 2018, when typically about 75% of ex-Yamal cargoes are normally sent to Europe. So indeed, the choice of selling more cargoes to Asia via the Northern Sea route is one of the driving factors behind a relatively tight LNG supply in Europe at the moment. However, despite this tight regional supply, we are still seeing re-exports out of Europe, which brings me on to the next topic. So next slide. So Europe indeed has some of the most flexible storage capacity in the LNG world, which makes it easier for them to undertake transshipments and do re-exports. The rationale behind it is it helps get around destination clauses and diversion limitations, which might not allow for direct delivery to a location that yields better profits to the seller. And it can also be for portfolio optimization purposes. Reloads out of Europe are a popular strategy when the market is in a contango, and when favorable arbitrage opportunities arise, Asia is therefore a prime destination for reloads from Europe. And indeed, Asia has been the recipient of 54% of European reloads last year and 76% year to date this year. If we take a look at the graph, we do notice that Q3 has seen record high volumes of re-exports out of there at 1.2 million tons as of mid-October, as Asian LNG prices reached record high levels and therefore attracted a lot of reloads out of Europe. If we take a more granular look into Asia, so typically the Far East is the traditional go-to market for European re-exports, especially for China and South Korea. We have noticed a surge in volumes to South Central Asia, which is now the destination for 50% of all EU re-exports so far this year. And we've also noticed that Latin America has become an increasingly popular destination for European reloads. And so far, 9% of them have been sent to that region due to higher regional demand. If we look at the origin of European re-exports, the main re-export terminal historically has been Zeebrugge in Belgium due to favorable re-export rates. And indeed, 63% of all EU reloads originated from there. But since the start of this year, in Spain, cheaper re-export rates have been implemented. And it has now become, as we can see on the graph, increasingly a popular location for reloads. And 36% of European re-exports originated from Spain so far this year, compared to just 5% last year. There is one major player that has taken advantage of European re-export capability, and that player is Qatargas, which will be the topic on the next slide. So if we look at Qatargas's trading strategies, traditionally, it has been a relatively conservative player. However, they have been strategically taking sizable chunks of market share in each major import market. And they now have offtake capacity in terminals in Europe, the Far East, and more recently in South Central Asia. It allows them to optimize fleet utilization and take advantage of locational arbitrage to increase their profit margins. And this is visible in two different ways. The first one is the increase in the use of backhaul or triangulation. So instead of the vessel returning ballast on the return trip to the main loading terminal in Qatar, which is Ras Laffan, the vessel is loaded with a new cargo at the delivery location or at a terminal that's along its return route. And this will minimize the time and distance where the vessel is ballast, and therefore net freight costs are reduced compared to a more conventional round trip from Ras Laffan and back. If we look at the graph, it's showing Qatargas-owned vessels loading at terminals other than Ras Laffan. And what's visible is we can really see the increasing use of this backhaul strategy, especially last year and so far this year, with a more extensive variety of locations for loading points for their vessels, which spans as far as the APAC region, the Middle East, and Europe. And this trend has also been exacerbated with the disruptions in the LNG market we've seen since 2020, so notably COVID-19 and the ensuing force majeure in Indian and Chinese ports, but also the Suez congestion that we had in March earlier this year. So it is showing us that Qatargas is increasingly becoming flexible in their fleet management to serve their major demand hubs as efficiently as possible. And the second method of doing this is Qatargas leasing their vessels for a one-time voyage to another charterer. before resuming normal voyage behavior out of Qatar. It is relatively rare, but we have seen notable instances of Qatargas-owned vessels being leased for loadings out of the US. So we've had 3 of those in 2019 and 2 of those so far this year, all out of Sabine Pass for delivery into India, Pakistan, and most recently into Kuwait. Lastly, just to finish off on this section, if we go to the next slide, we'll touch on the final topic, which is very relatable at the moment, which is European natural gas inventories. So the graph is showing daily European natural gas stocks, and what is quite visible is they are indeed lower than usual for this time of year, as October is traditionally the tipping point between injection season and withdrawal season in the region. As my colleague Kemi mentioned earlier in the webinar, we have reached kind of the lowest level in 5 years at 845 terawatt hours, and the inventory for Europe as a whole is at 77%. But what is very noticeable is there are some pretty high intra-European disparities. So some countries like France or Poland, who are at 95, 96% of inventory levels, are much more prepared than other countries like the Netherlands or Austria, who are struggling to get above 55, 60%. So some countries are clearly not as well prepared for the winter as others within the bloc, and it would be difficult to send natural gas around Europe on a short notice if multiple countries like Austria or the Netherlands were to suffer from last-minute shortages. On the LNG side, we also have noticed low LNG supply into Europe, especially in the UK, who've only imported 4 cargoes in September. So if the natural gas stocks for these countries who are struggling do not build quickly enough, we could see some very high bids for LNG cargoes in the coming weeks, and higher than any price that we've seen so far in the market. And therefore, regional shortages are indeed a very real possibility in Europe, and we could see the TTF price and therefore LNG prices in the region rise significantly. Possible solutions for this problem could be to reduce industrial activity, or Europe can hope that some more short-term supply can become available either via pipeline or perhaps via LNG cargoes. Thank you for listening to this section, and back to you, Arthur.
Thank you very much, Charles and Matthew. It's now my pleasure to welcome Dr. Bei Hua from CNPC. Dr. Bei, thank you very much for accepting Kpler's invitation. We are very glad to have you with us today. And I'll let you develop the content. And please, when you need me to pass to the next slide, just please say it in English, because I might not understand it in Chinese.
Okay, no problem.
Yeah. Yeah. Let's go when you're ready.
Yeah. Thank you, Arthur. 非常感谢 Kpler 邀请我参加这一次的这个线上会议。那么我今天呢，就是跟大家主要是想交流一下国际天然气市场的一个近期的形势，以及我们对明年这个全球市场的一个展望情况。那么首先这个第一张片子。我们能够看到的就是今年以来呢，随着这个疫情缓解以后，主要国家的这个经济复苏，那么在这个碳中和的目标的一个背景下呢，全球的那个能源转型持续的推进，那么这一系列的原因呢，就使得我们这个今年的一个全球的这个能源类大宗商品的这个价格持续的上涨。那么左边我们的这个表格呢，我们就对这个全球的原油价格、煤炭价格和天然气价格的涨幅进行了一个统计。然后我们可以看出来，这个天然气价格的涨幅是远远超过了这个煤炭和国际原油的这个价格。那么这个主要的3大市场，国际天然气3大市场来看呢，这个价格都出现了一个3地共振的一个情况，并且呢都在今年持续的达到了一个历史的高点。那么从美国的 Henry Hub 现货这个价格来看呢，1到9月的这个均价是在3.6美元左右每100万英热单位。那么它同比涨幅是在90%以上，是在页岩气这个革命以后 到目前为止呈现的一个最高的一个涨幅。那么从欧洲的这个 TTF 现货情况来看呢，我们可以看到欧洲今年的情况是非常非常的特殊。那么它这个价格呢，涨幅呢是3大市场里面最大的，应该是超过了300%，是自2004年这个有价格的，就是 TTF 有价格记录以来的一个最高价格，历史的高点。那么东北亚的这个现货价格，我们也知道，可能大家都很关心这个东北亚的现货价格。那么我这个图上的呢是给出的是 EIX， 是参考的是 ICIS 安讯斯 ICIS 它这个这个机构的一个估价。那么大家可能更多的看的是普世的 JKM 的这个价格，均价呢是在就是近期10月到岸和11月到岸的这个均价是在18到30美元以上了。那么日度的报价可能更高，那个 JKM 我所知的了解到的这个日度的报价已经50美元以上。那么这个 EAX 的最高的这个日度的报价是在39接近40美元。这个不管是这两个哪一个价格，都是远远超过了我们的一个心理预期，甚至呢我们认为它是已经超过了这个我们买方能够承担的这个价格。当然呢，这个呢有很多因素，我之后会提到。那 OK，other next slide。好，我们第2张片子呢，我主要是跟大家讲一下，分享一下这个全球这个主要地区的这个需求情况。这个图上呢，我是做了一个对全球2010这个全球的一个10年以来，可能这个图上的年份的这个标志被模糊掉了。这个柱子呢是年度，是从2010年到2022年的每一年的这个需求的增量。那我们橙色的可以看到是在这个每一年是不断的在增加。那唯一的就是这个绿色的柱子呢，这个年份应该是2020年，就是去年这个在疫情的影响下，我们的这个全球的需求出现了一个下降的一个历史性的下降。那么看今年2021年，就是绿色右边这一个浅色的橙色的柱子，它这个的需求的增量呢是一个绝对量。那么可以看到今年以来这个全球的天然气需求呢，我们只看这个1到9月的这个需求的数据的话，我们可以做一个大概的估算，也就是它应该是同比增加了4%，这个呢是远远超过了去年这个2020年的这个下降3%的这个消费的增速。那么也是高于我们过去5年，也就是13-15时期国内所说的这个13-15时期的这个平均1.6的这个增速。那么这个具体的来看的话，我们不管是北美、欧洲还是亚太，都呈现了一个需求持续的增加的这个情况。那么今年还有一个比较特殊的地区，就是南美地区，它是受到了这个极端天气，它持续的一个干旱天气，那么它的水力发电严重的不足，就造成了它这个 LNG 的需求大幅的上涨。那么我们可以看到这个北美的这个地区的情况来看呢，主要是受到了整个在疫情之后一个经济的复苏。那么美国呢又在今年的年初受到了一个暴风雪这种极端天气的影响，再加上它在今年夏季的时候也是跟南美一样，也是有一个干旱的这个过程。那么它的这个发电用气量是持续的攀升，同时呢，因为欧洲、亚洲的这个需求，还有南美的这个 LNG 需求很高，那么美国的 LNG 出口的这个原料气需求是非常高，那么造成了它整体这个美国的天然气需求的一个上升。那么欧洲也是，欧洲今年可以说是对这个全球天然气消费增长的一个最关键点就在于欧洲。那么它持续的一个推动环保政策，那么还有它的这个低温天气对天然气的一个需求，以及它的可再生能源的一个不足的情况，种种原因都造成了它这个供应的紧张，需求的增加。亚太就更不用说了，亚太是在这个几大地区 里边呢是这个需求是持续的增长的，哪怕是在这个去年疫情的影响下，亚太的这个天然气需求仍然是保持的正增长。那么今年呢也是保持了一个比较快速的增加。那么我们下一张片子我们就来看一下供应方面的。OK，other next slide。Thank you。这张片子我们是看一下全球的这个天然气供应的一个趋势。上面的这个图呢是对于整个这个供需的一个产量和需求的一个，产量是这个蓝色的柱子，需求呢是我用了绿色的这个线条。那么这个橙色的部分的呢，我是用的这个供需差的一个表示。那么我们可以从今年的这个上游生产的情况来看，不管是美国主要的供应国家，不管是美国还是澳大利亚，它都受到了不同原因的一定程度的影响，那么造成了这个全球的天然气产量的增量是自2015年以来首次呢是低于了这个全球的天然气需求的这个增量。那么和疫情前的2019年的这个绝对值的数据相比呢，这个今年的产量的增量是下降的，而这个需求的增量是呈现了一个明显的上涨的情况。那么从上半年这个具体的 OECD 国家的这个产量来看呢，它是同比下降了2.2%。美国呢是受到了这个极端天气的影响，天然气的这个产量也是一个下降。那么澳大利亚一个是它上游气田的影响下降，还有呢就是它的这个液化出口也是在不断的检修呀，还有一些故障，所以对它的这个出口的供应，对全球的一个供应也是有一个影响的过程。那么我们这个原计划在2021年，就是今年原计划是要新增的960万吨的这个液化产能呢，截止到目前只新增了600万吨，那么是较计划是欠计划的。那么再加上刚才前面的这个 Kpler 的专家也提到了这个LNG 工厂的这种项目的这种开工率也是低于往常的，所以这些种种的原因加起来，就造成了我们今年以来全球的这个天然气市场和 LNG 市场的一个持续的收紧的过程。OK，next slide。我们具体的来看一下比较关键的这个几个地区的情况吧。这个呢是我对这个欧洲的一个市场的情况，可能大家都已经是非常了解的了。那么今年呢，欧洲的天然气这个需求呢是呈现了一个超预期的一个增长。主要的原因有几点。那么第一点呢，首先是我们都知道欧洲国家对这个环保是非常非常关注的。那么他们的一个非常积极的一个环保政策，推动这个可再生能源的一个发展的这个政策呢，在今年表现的尤为突出。那么他们持续的减少核电，减少煤炭，然后并且是替代石油替代油。那么这些政策都是在集中的推进，那么就造成了这个碳交易 EUA 的这个碳期货交易价格呢一个持续的上升。那么在9月份的时候，这个价格已经超过了70美元每吨，现在呢仍然保持一个65左右的这个高位，是比可以看到往年的这个同期，就包括是去年的这个同期呢，现在的价格都已经是去年同期的120%了。那么再加上这个今年以来这个欧洲的太阳能和风力发电的不足，这个新能源可再生能源的一个处理不足，对于欧洲地区的这个用能的影响是比较大的。那么它的这个就造成了它天然气需求的一个大幅的超预期的增长。再叠加今年欧洲也是受到了这个比较寒冷的极端天气的这个影响，包括夏季的一个高温的影响，都是对它天然气的需求有一个推升的作用。那么我们从供应侧来看的话，欧洲地区的供应我们可以主要分为3块。第一个呢就是欧洲区域内的 这个像挪威呀这种气田的一个供应，第二个是俄罗斯的这个管道气的供应，然后就是区域外的 LNG 市场的一个供应。那么今年来看的话，挪威的管道气出口到欧洲地区区域内的话，它是占到了欧洲消费量的20%，但是今年挪威气田频繁的一个生产的故障停产这种情况，就造成了挪威对这个欧洲的供应下降。那么俄罗斯方面对欧洲的一个供应呢，由于那个 Gazprom 它预定的这个过境乌克兰和波兰的这个管道的输气能力是不足的，所以它对欧洲的一个天然气的供应也是受到了一定的限制。那么在LNG 市场方面呢，我们可以看到今年在这个区域市场的需求侧的竞争是尤其激烈的。那么欧洲的需求很高，南美的需求很高，亚太的需求依然很高，对这个 LNG 市场，特别是现货的一个争抢是非常激烈的。那么这个特别是美国的这个 LNG 现货，大部分都流向了南美市场，供应欧洲的量就出现了一个下降。那么今年1到9月，欧洲 LNG 的进口呢只有5600万吨，是同比下降了接近30%。那么是比那个2019年疫情前的呢是下降了13%。我们可以看到，由于这样的一个供需紧张的一个情况出现呢，那么欧洲这个地下储气库就在前期呢进行了一个持续的采气，它都需要用储气库里的气来满足它的这个需求。所以今年以来，左边的这张图上可以看出，红色的线条是2021年今年的这个欧洲地下储气库的一个这个线，你可以看到它是比这个绿色的16年到20年的一个最高和最低值的一个平均水平，它都已经低于了这个最低线。那么在目前来看的话，到10月了，虽然这条线已经开始往上走了，这个储气库也在不断的就是补库，也在注气，但是呢，它仍然是低于往年同期水平的。所以说，这个今年欧洲的这个情况呢，是对全球这个天然气供应紧张的一个形势的一个关键点，就处在欧洲。好 ，next slide。好，下面呢，我们看一下亚洲的这个情况。那么我们都知道，亚洲是个传统的这个3大市场里面需求最高、增速最快的一个地区。那么今年呢，依然是这样的情况。从1到9月的这个数据来看的话，全球的这个 LNG 的需求是大概在2.88亿吨左右。这个同比的增量是在1760万吨，增幅是6.5%。那么这个其中呢，我们可以看到亚洲的这个 LNG 需求的增量，是达到了2300万吨左右。那么它是超过了这个全球的一个增量，弥补了其他地区的一个下降。同时呢，我们也可以看到南美的这个需求的增量呢，也是在今年表现的比较特殊的，因为刚才提到了它这个极端天气的影响。那么以往的话，南美的这个需求的没有表现这么一大块，有650万吨的这个需求的增量，以前是没有这样的情况出现的。那么我们从这个具体的国家来看的话，我们都知道日本、韩国是亚洲最主要的一个这个传统的需求国。那么今年来，可以看到在日本和韩国它的这个需求进入平台期以后，那么今年它的 LNG 需求呢是呈现了一个上升的一个走势。那么主要的原因呢是日本的这个核电重启的进程比较缓慢。那么韩国呢在从去年年底到今年都一直在推行这个降核减煤的一个政策，那么他们都是利好这个天然气的需求，因此在1到9月的时候，日韩的 LNG 需求分别的是同比增长了3%和21%。那么中国和新兴的亚洲这些需求国呢，就表现的就更加明显了。那么在中国来看的话是 一方面是受到了这个宏观经济向好，然后中国国内的这个煤改气政策的一个推进，并且呢今年以来国内推行的这个能源双控以及这个双碳目标的这个进程，这种拉动呢，使中国的这个天然气需求增速在今年表现了一个2位数以上的非常非常明显的一个增加。那么这个中国的这个需求的增量 ，LNG 的这个增量占到了亚洲这个增量的近1半的水平。那么从这个亚洲的其他的新兴国家来看，包括泰国、印度尼西亚还有巴基斯坦在内，他们的增速在今年也是表现了一个非常大的一个增速。但是呢，从供应侧来看，供应亚洲的主要的这个国家是澳大利亚，但是它呢，我们刚才看到了这个澳大利亚的天然气的上游的产量是有一个3%的下降。那么同时呢，因为它这个液化项目的一个产能一个是不足，开工率不足，受到的是频繁的减产、频繁的停产的这种影响呢，它这个液化出口也是在不断的下降的，是加剧了这个供应的紧张形势。OK，next slide。好的，那么我们对这个这是刚才我们说到的是今年的一个全球天然气的需求情况。那么我们对明年的这个形势也有一个判断。我们认为呢，整体来看，2022年的全球的天然气供需形势呢将会有所缓解。那么是基于几点，首先呢就是这个需求方面，我们认为在明年的这个情况来看呢，是疫情呢应该是在明年会处于一个疫情防控的常态化的一个，就是大家已经可能都已经习以为常了，控制的比较好，大多数国家都控制的比较好了，虽然会有一些反复，但是呢，就是对这个生产呀、生活呀这样的影响会减弱，会比去年和今年也进一步的减弱。那么这个全球的这个经济形势呢，也应该是在一个持续的复苏的这个状况。那么我们对国际油价的这个判断呢，也是会在一个比较企稳的一个状态下。那么我们预计明年这个全球天然气的需求呢，要增速呢会维持在2.3%左右。那主要的这个需求的部门呢是发电和工业这2个部门。那么它这2个部门的这个增量，我们进行了一个测算，应该是能占到这个总的需求增量的80%以上。那么从生产端来看的话，明年因为今年的这个美国这些澳大利亚这些主要的生产国的多多少少都受到了影响，但是目前来看已经在一个恢复的阶段了，所以我们可以看到的是，明年我们认为它的这个生产端是会加快的恢复，那么对这个全球的这个供应紧张的形势会得到一个缓解。那么现在的这个气价，不管是欧洲、亚洲，包括美国的这个 Henry Hub 的气价，我们都看到都是一个处于相当高的一个位置。那么再包括现在的油价水平，其实它都是对天然气都是利好天然气生产的。因此我们预计明年的这个天然气的生产的增速会高于需求的增速，天然气产量增速会达到4%，那么需求增速是2.3%，所以整个从这个需求的供需差来看，明年是会有一个略宽松的这个形势。那么我们这个是一个比较乐观的一个估计啊。Next slide。OK，这个呢，我们是对这个明年的一个液化 LNG 市场的一个判断。那么我们从这个液化产能来看的话，今年我刚才都说到了，就是咱们今年的960万吨的这个计划新增的产能，实际上只新增了600万吨。那么这个图上左边蓝色的这一部分呢，是计划在今年投产，但是还没有投产的这些产能。如果在第4季度他们没有进行一个加快的这个上产的话，那么 很大的这个几率就是在明年进行一个投产。那么右边橙色的这一部分呢是，我们通过对这个项目进度的一个评估，然后认为它极有可能，它这些项目首先它是宣布了要在明年进行一个新增的这个投产的，但是呢，有很多项目虽然宣布了，但是我们对它的这个进程的一个评估包括我们跟这个机构的一些交流，我们认为乐观的估计呢，明年是有2300万吨的这个液化产能，有望这个投产，这是最乐观的一个估计。当然呢，这个产能是肯定是远超过今年的这个新增的产能，所以我们在液化的这个方面呢，我们可以看到呢，这个 LNG 供应的紧张的形势呢，会在这个新增产能的一个带动下有所缓解。那么这个新增的产能呢，主要是来自于美国。你可以看到这很多个项目都是美国的项目。那么我们预计到明年这个全球的液化产能将达到了4.9亿吨，同比增速是接近5%。OK，next slide。好，我们来看一下这个我们对这个地区市场明年的一个分析。那么我们认为在明年的话，这个亚太的一个天然这个需求的增速是会放缓的，所以它会带动这个亚洲的这个现货价格一个下行。那么同时呢，我们认为这个全球来看的话，有好几方面的因素会使得这个天然气需求增速放缓。那么首先呢，就是欧洲和南美的一个需求。那么今年刚才提到了这个欧洲的这个需求是一个超预期的，我们认为它只是在这种一个特殊情况下，因为欧洲的这个比较积极的这个可再生能源发展的能源政策的推动下，但是它这种对天然气的一个需求，因为现在价格这么高了，天然气发电已经不经济了，在欧洲，他们就是明年呢，同时又会上一些可再生能源发电的这个产能会上线，所以对这个欧洲的天然气需求会有一定的限制。那么我们认为这个欧洲和南美的需求在明年会出现一个下降，因为南美今年也是一个很特殊的情况，是因为它的极端天气影响的。那么如果在明年没有这个极端天气影响的情况下呢，它的需求会放缓。那么第二点呢，我们认为这个明年日韩的这个 LNG 需求也是会放缓的。因为这个首先日本呢，它是这个重启核电的这个进程其实是在不断的持续的推进的一个过程。那么至于它这个重启的是加快还是怎么样，不管它是放缓还是加快，但是它一定是对这个天然气需求是有一定的影响的。那么韩国也是，韩国今年从去年年底到今年推行的这个降煤减核的这个政策呢，计划本来就是到今年，在明年呢，它的这个需求，包括他们现在的这个库存也还是相对来说比较高的，过了这个冬季以后，他们的整个 LNG 需求的进口的就会放缓。那么第三点就是可能大家都比较关心的就是中国的 LNG 需求。那么我们认为在2022年明年的这个中国的这个 LNG 需求增长也是会放缓的。为什么呢？因为首先今年的这个需求的超预期这么大幅的增长，我们认为它其实是很多短期的因素的一个影响。其中最主要的呢就是特别是今年上半年，这个由于疫情。国外的这个疫情还处于一个相对来说比较紧张的一个形势的时候，国外的国际的这个需要中国大量的出口的工业品，那么对这个因此中国对天然气的需求是很高的。但是从今年下半年特别是第3季度以来，我们可以看到中国的这个 PPI 的已经是呈现一个下行了。那么因为国外的一个经济的复苏、疫情的控制，那么对中国的这个工业品的这些出口的需求没有那么大了，那么中国的工业的这个用气需求会受到一定的抑制。那么第二个就是我们可以看到，就是现在这么高的这个现货价格，中国的这些我们称之为第2梯队的这些企业，就是除了中国的3大国有的石油公司以外的这些企业的 对现货的进口速度已经是在呈现一个就下半年6月以后已经呈现一个比较下行，就是观望的态度。因为这么高的这个价格，谁都不愿意就是去买到高价，都愿意观望。那么当然在这个冬季需求比较高的时候，肯定有一些刚需。那么除了这些刚需以外的这些需求呢，就会受到这个高价的抑制。因为同时受高价抑制的还有这些印度以及新兴市场的这个亚洲这些刚才我们提到的这个泰国呀、巴基斯坦呀、马来西亚这些国家的一个需求，都会在高价的这个影响下呢，得到一定的控制。那么在明年来看的话，如果这个价格特别是在今冬明春明年春季仍然是处于相对较高的价格的话，那么这些需求是不会得到释放的因此我们对这个明年的整个形势呢来看的话，是一个认为它是供应趋紧的形势一定会比今年有所缓解，价格呢会从今年的一个高点往下行的一个态势。那么以上呢就是我们对这个全球天然气市场的一个看法。那么非常感谢大家。好 ，Thank you, Arthur. Back to you.
Thank you very much, Dr. Bay. We will now take a 5-minute break, and we will be back at 4:20 p.m. Singapore time. We'll see you in 5 minutes. And we are back online in this APAC LNG Day. Now I will hand over to Matt Wright, Senior Freight Analyst at Kpler, and Dingwen Huang, Product Analyst, for an outlook on the LNG freight market. Matt, you can go on.
Brilliant. Thank you very much, Arthur. And good morning and good afternoon, everybody. Yeah, so moving on to freight for the final part of the session, and we've got a lot of interesting things to dive into. Today, we're going to focus really on where we are at the moment in the market and looking ahead to this winter, because I do think it's going to be a particularly interesting topic. As Laura and Camille mentioned in their presentation earlier, the US is a key source of marginal supply for the freight market. And the destination of these cargoes combined with the freight dynamics in the region really will determine whether we see a continued rise in rates this winter. And so in this session, Dingwen and I are going to go over a few of the key metrics available on the Kpler freight platform and how they can be used to assess the status of the freight market as we head into winter. So next slide.
Yes, thank you for this intro, Matt. I just forgot to mention that to all participants that if you want to ask questions, do not hesitate to drop questions in the Q&A box, either in English or in Chinese. We probably won't have time to answer them today, but we'll come back to you individually. Sorry for this short interruption, Matt, you can go ahead.
No problem. So starting with fleet growth. The deliveries this year are projected to reach around 8.3 million cubic meters. This is a 9% increase on 2020. The XL fleet, which we define at Kpler as 145,000 deadweight tons to 200,000 deadweight tons, is expected to grow around 15% and now accounts for about 72% of the LNG fleet, which is up from 64% at the beginning of 2019. We'll dive a bit deeper into the XL segment in a moment, but just focusing on the global fleet for a moment. As export volumes have been comparatively firm over the summer, the excess vessel capacity from this fleet growth has actually been similar to last summer, despite the increase in the fleet. And you can see that in the June to sort of August part of this chart, where the orange and the green lines are actually relatively in tandem. You would expect with fleet growth exceeding the growth in exports that this would be higher during the summer months. But because a combination of regions and mainly the high exports, this has actually not happened, which is significant. The high fleet growth has meant vessel supply growth has exceeded exports, as I mentioned, on a volume for volume basis. But with more cargo now shipped on longer voyages, this is becoming actually a necessity. And over the next few years, it's likely this trend will need to continue. And looking at where we are now on the chart, sort of heading into October, the cargo ratio is broadly the same as last year. So the orange and the green lines there are broadly in the same position. Now, this isn't to say we're going to end up in a similar freight situation, but I just think this is an important thing to note. This could be more of a concern that last year, however, as the market now requires a higher ratio of vessels to cargo to make up for those longer voyages, which I mentioned earlier. So just something to keep in mind. I'm now going to pass over to my colleague Dingwen, who's been looking into dry dock activity this year and how that plays into vessel availability.
Next, please, Arthur. Most certainly, Matthew. Hello, everyone. Thank you for joining us today. My name is Ding Wen, and I'm the Freight Product Analyst based in Singapore. So we have a key observation here. Heading into Q4, we observe more vessels having been sent to shipyard year on year. First and foremost, an uptrend in shipyard activity is a healthy COVID recovery sign. Many owners and charterers had to defer their dry dock requirements from last year due to COVID restrictions and disruptions at many shipyards. In addition, several opportunistic charterers have pressured their owners to bring forward dry dock requirements so as to maximize their fleet numbers for this year's winter deliveries. Technically speaking, the absolute count of vessels available this winter should be higher because of what we have seen for the shipyard activities. But will these vessels now be at the right place and at the right time for winter? So after last winter, there was a market consensus really. Improved vessel scheduling strategies are needed for suppliers to sync up with the committed swaps and deliveries, and also to cope with winter gyrations. Due to the nature of LNG storage and boil off, vessel scheduling is extremely date and voyage sensitive. In the event of severe mismatch with the required dates, we have seen that bid prices will spike significantly in order to secure prompt replacement vessels. Even if majority of the winter cargoes have been fixed via forward deliveries, suppliers may unwind committed swaps and seek replacement deliveries if the vessel movements cannot be executed according to plan. Despite fine-tuning and adopting the most optimum vessel scheduling possible, there are critical threats that can endanger your winter supply program. Suppliers with poor vessel reliability may get punished by the high cost for prompt replacement vessels. Also, terminal congestions in JKTC, either due to weather or vessel lineup, may have a domino effect on subsequent scheduled deliveries and discharges. Last but not least, owners, charterers, and traders will be closely monitoring the GEO-ARB incentive driven by the tight vessel availability in the Atlantic Basin. And on that note, Matthew will lead us through a deep dive of the Atlantic Basin situation.
Thanks, Dingwen. Next slide, please, Arthur. So, as the US is the fastest rising source of supply, the US Gulf is also the fastest rising area of vessel supply growth. As a large number of US exports are going to Asia, typically larger vessels are required to make the voyage economics workable, and therefore the number of XL vessels has increased significantly, as you can see from the chart on the left. Since the start of 2019, the average number of vessels, XL vessels operating in this region on any particular day has doubled from around 60 to 120. On the chart on the left again, you'll note that there was a sustained high number of vessels in the Atlantic over the summer. And this was because a significant volume of the increase in exports over the summer from the US compared with last year was from the US to Brazil. So these vessels actually stayed within the Atlantic and have been able to return to load ports more quickly. This is significant in terms of maintaining vessel availability moving into the winter, but it might not necessarily be a determining factor in what we see rate-wise. Turning to the chart on the right, which shows the ratio of fleet capacity to exports, you'll note that available capacity dropped sharply during the winter last year, which was caused by that sharp rise in rates and exports to Asia, and resulted in a sharp rise in rates as a result. The question is, will there be enough vessel supply moving into this winter? At the moment, the balance is relatively similar to where we were last year in the sort of September to October period, but this could change quite quickly if more cargoes do head to Asia, drawing out vessel supply from the region for longer periods of time. Should this happen, congestion at the Panama canals could rise, which is something Dingwen's going to highlight what we need to look out for should that happen.
That's right, Matthew. And specifically on Panama Canal, we know it is the shortest passageway for LNG vessels between the US Gulf and East Asia. So ships with reservations usually transit smoothly on their book days, while those without reservations are subjected to longer waits. However, the fuel savings from shorter sailing days can be easily eroded by other operational costs incurred due to canal congestion. Suppliers are hence extremely mindful about congestion due to the cargo boil-off, expensive idle days, and knock-on impact on operational matters like bunker and crew change. Using Kpler Freight Analytics tool, you will be able to retrieve real-time data to analyze the historical fluctuations in congestion duration and vessel count. As seen from the graph, there was a surge in number of vessels waiting to transit last winter when US cargoes was routed to meet prompt urgent demands in the Far East. For some vessels which did not have pre-booked slots, we observed that the waiting time could stretch up to almost 2 weeks. This summer, there was an initial spike in congestion as more cargoes headed east, until a recent shift in exports to other destinations, particularly Brazil. If we see a repeat of last winter, whereby US cargoes are being diverted to meet prompt urgent demand in Far East, congestion duration and vessel count will inevitably ramp up again. In fact, higher round-trip economics from longer waiting time could provide an incentive for suppliers and owners to drive towards even more eastward transit to around the Suez Canal or Cape of Good Hope. Back to you, Matthew. What are some of the freight metrics and prices trends that our audience should be looking out for?
Yeah, thanks, Dingwen. Next slide. So here we're going to take a look into the ton miles and ton day metrics. So ton miles and ton days are very important measures of freight demand. Ton miles are, for those who don't know, is total cargo in tons multiplied by the distance traveled, while ton days is cargo multiplied by the length of the voyage in days. Monitoring both of these metrics is very important in understanding the health of particular markets, and the dynamics between the two metrics is often very interesting. So here I've indexed ton miles and ton days since beginning of 2019 to show the relative change in each. Periods where ton miles rise faster than ton days are typically indicative of vessels moving faster. So as you can see, looking at heading into last winter, the red sections have shunted slightly, I think, during the reformatting. They're meant to be over the sort of November to December period. So you can see in last winter, the congestion caused by the lack of capacity in the Panama Canal forced over half of January exports from the US to go via the Suez Canal rather than the Panama Canal. Prior to this, export via the canal made up less than 5% of cargo volume shipped from the US to Asia. This, combined with vessels traveling faster, significantly increased ton miles relative to ton day demand, despite the fact that congestion was relatively high. You look to the period, the winter in 2019, vessel speeds increased, but we weren't seeing the same volume going via on the longer voyages. And so there wasn't the same impact in terms of the dynamic between the two measures. So, and then on the other side, when periods where ton days exceed ton miles, this generally indicates where the fleet has slowed down and where there is significant congestion. So this year, the increase in exports from the US has actually meant that the voyage from the US to Asia via the Suez Canal is actually becoming increasingly common. And this year, around 20% of exports to Asia now go this way. The average speed of laden vessels in this year has been higher than last year. And usually a faster moving fleet requires fewer vessels to service the same volume of cargoes. So for the average speed to be higher and with freight rates to be rising really does highlight that the market is still very, very tight this year. So where are we now heading into the winter? Vessels are traveling faster than they were this time last year, but it'll be very important to keep an eye on which market vessels are heading towards and what route they're taking, which leads me on to the next slide, which is looking at current netback situation. So I wanted to finish by looking at the current netbacks, as where spot cargoes from the US are headed will have a very significant bearing on freight rates. The region with the most attractive netback to US producers will draw the most cargoes. At the moment, it's Asia, as you can see from this chart, with the light blue. This is taking into account forward curves from November, December through to January. And this would tie up vessels on longer voyages, driving up rates. But I really do need to emphasize this is very marginal. And what's significant is this is only, the netback is only positive via the Panama Canal. The dark blue line, which shows the netback via the Cape of Good Hope, actually favors Europe. So this is a really, really important metric to keep an eye on over the next days, weeks, months, because this is likely to swing back and forth depending on what the demand situation in either region is likely to develop. So as we said, if you change those freight assumptions to go via the Cape or the Suez, then Europe, the marginal cargo is likely to head to Europe, which would actually lead to maybe more of a slowdown in rates, a drop in rates, because there are shorter voyages and fewer vessels will be required. There is a huge amount of volatility in gas prices at the moment. So I think the key takeaway here is not that the margin currently favors Asia or Europe. It's that the spread between the two netbacks is very marginal and can easily switch. So to summarize, we've got quite a very different set of circumstances heading into the winter this year compared with last. But the result in terms of freight rates could well be the same. Last year, we had weak demand as a result of global lockdowns and reduced export volumes, which resulted in a large amount of floating storage over the summer. Whereas this summer, we had sustained high exports, albeit some on shorter voyages within the Atlantic. Scheduled dry docking has been higher this summer than last in order to make more fleet available this winter. And last year, the demand spike came from Asia almost predominantly, whereas this year, as we've seen, it's unclear whether Asia or Europe will be most in need of those marginal cargoes. The highest paid netback will have a strong bearing on freight this winter. And moving on to where the freight market is at present leads us quite nicely onto the Spark team. So I'll leave you there. Thank you very much.
Thank you very much, Matthew and Dingwen. We are now heading to the last section of this seminar with Henry from Spark Commodities. Spark Commodities, as you may know, is a sister company of Kpler. Henry, can you start? Lots of interesting content here.
Thanks, Arthur, and thank you to Kpler for inviting Spark onto this webinar. So in this section, we're going to be looking at LNG freight rates. So looking at where the market is now and how expectations are shaping up for the winter months. Next slide. Before we jump into it, just a brief introduction. So all of the freight rates and data that we're going to be looking at come from Spark Commodities. And so for those of you not familiar with Spark, we're focused on price transparency in commodities via our technology platform. So you can see from the timeline there, since inception 2.5 years ago, Spark has been heavily focused on LNG freight price transparency. And that's resulted in the ICE listing earlier this year. So ICE chose Spark to partner with to list their long-awaited LNG freight futures. So those futures settle against the benchmark Spark 25 Pacific and Spark 30 Atlantic rates. And you can trade those now via a range of brokers who offer the product. In addition, we're pleased that now over 200 firms and 1,000 users use the Spark LNG Freight platform, and you'll be seeing screenshots from that platform throughout this section. Next slide. So we have two LNG Freight benchmark spot rates. So these are the two used in the ICE listed futures. The Spark 30 is the Atlantic benchmark, which is Sabine to Gate and a 30-day round-trip voyage. And the Spark 25 is the Pacific Basin benchmark, which is Northwest Shelf to Tianjin, and it's a 25-day round-trip voyage. And on the Spark platform, we have a range of freight rates based on these two benchmark routes, from spot to forward curves that go out to 2024. And we have all the rates in dollars per day, but also in dollars per MMBTU for the cargo traders. We also recently integrated the Spark spot rates into the Kpler terminal. So you can now see those Spark benchmark rates alongside all of your Kpler data and analytics. Next slide. Okay, so let's take a look at the LNG freight market as we head into the winter. So these first two charts here really show the extreme seasonality in LNG freight. So clearly LNG freight has different characteristics to the commodity in that it's higher rates and it's not storable across months like the commodity is. And so that seasonality of demand is almost directly translated into that price seasonality. So the chart at the top shows the historical Spark 25, that's the Pacific spot rates over the last 2.5 years. So you can see that move higher in winter 2019 on the left-hand side of the chart when rates went over 150K, which was then surpassed last winter when rates spiked to over 230K for the Pacific in early January, through to now where we are a little under the all-time highs at just over $200,000 per day for the Pacific Basin. You can also see the Spark FFA forward curve on the chart below, which we have out to 2024, which again highlights this seasonality. So we can see that the highs on the Spark 25 FFA forward curve for this winter are around 200K per day in December. So the FFA market not pricing in a huge amount of upside from here, but of course, things can change very quickly in this market, as we know. Next slide. So as I mentioned, we're now moving into the peak winter months for rates. And historically, October has been a transition month into those higher rates. And we've definitely seen that again this year. So we can see here the top two charts on the right are the price action for Spark 25 in October 2019 and October 2020. So the green dots are the spot rates throughout the calendar month, and the green line is the cumulative average over the month. So the short story is that we saw rates more than double over those two previous Octobers. Obviously, we're not yet through October this year, but very clearly this seasonal pattern is repeating itself again, and this year in an even more extreme way. So just 3 weeks ago, on the 1st of October, the Spark 25 spot rates were at just over 70K per day. And now, as I mentioned, they are sitting at just over 200K per day. So that's a rally of 187%. So not far off tripling so far in October. And obviously we still have a few days remaining. Next slide. So the spot is moving up sharply, which is in line with seasonal patterns, but in a more extreme way this year. We can also see that the price dynamics so far this year are a little different to previous years, in that this year it's the Pacific Basin spot rates that are leading the move higher. So this chart shows the spread between the Spark 25 Pacific spot rates and the Spark 30 Atlantic spot rates. So that sharp move lower in this chart last winter, around the middle of the chart, was as Pacific rates moved to a $100,000 per day discount to Atlantic rates last winter. So at that time, there was extreme tightness in the Atlantic Basin, and there was a wide Northeast Asian LNG to TTF price spread, causing strong demand for vessels to load in the Atlantic and go to Asia. This year, the picture is slightly different, as the TTF to Northeast Asian LNG price spread remains still quite narrow and variable, as Matt was describing. And there's been more competition from Europe for US cargoes, keeping some vessels in the Atlantic, and we're now seeing the tightness appear in the Pacific. And you can see the Pacific premium is now sitting at an all-time high over the Atlantic at 64K per day. Next slide. So freight rates have moved sharply higher in the last 3 weeks, with rates in the Pacific leading the gains. Let's look at how this relates to LNG cargo pricing. So the forward curves that you see here are dollar per MMBTU cost curves for transporting LNG from Sabine to Tianjin via the Panama and from Northwest Shelf to Tianjin on the right-hand chart. And these use the FFA dollar per day forward curve, as well as an assumption that LNG is used as fuel and port and canal costs that we get from Spark's partnership with GAC. So you can see, based on the current prices, it costs around $4.75 to move LNG from the US to China, and around $2.25 per MMBTU to move from Australia to China. And the main takeaway here is that with today's extremely high cargo prices, these freight costs are a relatively small part of the cost of delivered cargoes. And also importantly, a relatively small part of the spread between a Henry Hub indexed US cargo that's potentially for FOB and a Northeast Asian priced delivered cargo. So there's certainly still an outstanding question as to whether we will see a significant additional tightening from here in the LNG freight market this winter. But if that were to happen, you could certainly argue that the ceiling price from the cargo market, i.e. the point at which freight would start to interfere with cargo economics based on FOB US Henry Hub index cargoes at least, well, that ceiling is much higher than the current levels priced into the forward curve. Next slide. So just to conclude and wrap up, LNG freight spot rates are rallying sharply in line with seasonal patterns, but in a more extreme way so far this year. Currently, the tightness is appearing mostly in the Pacific Basin, with the dynamics this year of Europe continuing to compete for cargoes, and as such, keeping some vessels in the Atlantic Basin. And finally, given the high cargo prices and Henry Hub to global LNG price spreads, the potential ceiling to LNG freight rates, if we do get more tightness, could be much higher if we do get that additional tightness in vessel availability. So on that note, I'll wrap up. I'll say thanks for your time and hand back to Arthur for the final comments.
Well, thank you very much, Henry. We are now reaching the end of this seminar. We really hope you liked it. Again, feel free to send your questions to research@kpler.com. If you want to know more about the Kpler various offerings, you can either ask a trial on kpler.com if you are not already a client, or reach out to sales@kpler.com if you need more information about the offerings. I would like to thank all the speakers today, all the participants. Thank you very much, Dr. Bay, for being with us. Thank you also to Henry from Spark. And yes, we will probably organize a similar seminar in the next few months. Meanwhile, the presentation and the recording of this seminar will be sent to you in a follow-up email tomorrow. Thank you very much again, and have a very good end of the day. Have a very good day. See you next time. Bye-bye.
Thank you. Bye-bye.
Yeah. And then you may also have seen the...
Thank you.